Accounting choices that affect the cash flow statement. Question 2. Which action by management would most likely result in a temporary increase in cash flow from operations? A reclassifying dividend payments from financing activities to operating activities under IFRS. B. Accelerating cash collections from customers by offering early payment discounts. C. Capitalizing development costs that were previously expensed immediately. Correct answer, B. By offering early payment discounts, management encourages customers to settle their invoices ahead of schedule, which is beyond the usual credit terms. This leads to a quick boost in cash coming in from our day-to-day operations. The good news is that we're getting paid sooner, which means we're seeing more cash in our pockets right now. On the downside, we might see a tiny bit less revenue because of the discounts. But hey, the earlier payment makes up for it, so overall, our cash flow is still looking good. This might give us a quick boost in cash, but it's not going to be a long-term fix for really making our business shine. Basically, it's just a way to shift when we get paid. A. Incorrect. Dividends are usually seen as money going out to finance things. If we move them to operating activities, it would look like we're spending cash there, which isn't great. The downside is that it would make the net cash from operating activities look smaller, which could make operating cash flow seem less strong. Most companies try to keep them where they are because it doesn't help their operating performance look good. C. Incorrect. When we move development costs to the investing activities, it changes how we see the cash flow period. Instead of seeing it as an expense in operating activities, it's now seen as the purchase of an intangible asset. Negative impact on operating cash flow : This change means we'll see fewer cash outflows in the operating section, but it doesn't actually boost our operating cash flow period. It's just a different way of looking at the same thing. Positive impact on net income. By capitalizing costs, we get a higher reported net income because we're spreading the expense out over time through amortization. However, this doesn't really improve our operating cash flow. Question 1. A financial reporting manager is evaluating strategies to improve reported operating cash flow under the indirect method without enhancing underlying business performance. Which strategy would be most detectable to external users via working capital trends? A. Reclassifying interest paid as a financing outflow under IFRS. B. Delaying supplier payments by extending terms from 30 to 60 days. C. Capitalizing additional routine maintenance costs as assets. Correct answer, B. If you're holding off on paying your suppliers, it can make your accounts payable, AP, look bigger than it really is, which is a key part of your working capital. When you use the indirect method to figure out your CFO, an increase in AP gets added back to your net income, which can make your cash flow look stronger than it actually is. Here's how analysts can catch this. Days payable outstanding, DPO. If your DPO jumps suddenly, like from 30 to 60 days, it might mean you're not paying your suppliers on time. Comparing CFO to MNI ratios are working capital turnover. See how your CFO and working capital turnover compare to what other companies in your industry are doing. Reviewing footnotes. Check the footnotes for any changes in how you're paying your suppliers, though this might not be as clear as looking at trends. A. Incorrect. IFRS IS7 lets you decide whether interest paid is an operating or financing cash flow period. If you move it to financing, it might make your CFO look better, but it won't change your working capital, like accounts payable, accounts receivable, or inventory. To figure out if something is detectable, you'll need to look at the accounting policy details in the notes, not just how your working capital is changing. These changes are seen as presentation choices, which makes it a bit trickier to follow them through working capital analysis. C. Incorrect. This misclassification can hide operating expenses by treating costs that should be expensed as capital, which can make net income and the CFO look better than they actually are. But it mainly impacts non-current assets like property, plant, and equipment, and how much money is being invested rather than the money we have on hand. To figure out if this is happening, you'd need to look at how companies handle capitalizing costs compared to what's standard in the industry, or by checking how quickly they're using their assets. not just how much money they have.